Welcome to Share Views, where I'm delighted to say I'm joined by Ranjeet Singh, Director of London Stone Securities. How are you today, Ranjeet?
Very good, thank you, Zach. Thanks for having me.
A delight. I can't resist asking or talking about the day you founded your brokerage. I mean, obviously you've got, as a broker, you need to have perfect market timing, and you did have that, didn't you?
Well, the day I got my license, I think I mentioned this last time as well, Zach, was the day that Lehman Brothers went bust.
Right.
So literally I was sitting at home at my grandma's house, and let came through the post. I had it addressed to my grandma's for different reasons. Came through, opened it up, there it was. Well done, congratulations, you got your license. As I turned to put the TV on, people carrying boxes full of the biggest collapse in financial history, 150 years. So it was quite. Nothing to do with me, of course, the collapse of Lehman Brothers, but quite coincidental, shall we say.
Well, and presumably the letter was sent. The letter was also not under your control either. I mean, it could have been.
Exactly.
It could have been any time in a 3-month window, presumably.
Exactly. It could have been on the day that maybe Northern Rock went bust.
Right.
Exactly.
So we're now about 10 years ahead of that. On from that, we've had it's been plain sailing, let's say, against all the odds. Are your clients, they're trading derivatives? Are they cautious? Are they scared? Are they happy? What's the mood?
I guess everything, all of the above. You've got some clients who are very cautious. We've got some clients, for example, who sold just after Brexit, against our advice, by the way, I should say. Yeah. They saw the market down to 6,200, and they thought, good call. Market's going to go a lot lower. Now, of course, fast forward nearly a year, we're now 7,500, and they're in a very painful place because not only have they lost a year's worth of income, growth and everything else, but also, of course, if they jump in now, they may have caught the top of the market for all the wrong reasons. And then, of course, we've got some investors who just sort of like to play the long game, dividends, good income stocks. I had a conversation with one of my clients this morning, actually, about this very thing, and I said, look, at the moment, the equity markets are very robust. You can't go against a trend. So if you look at corporate earnings, you look at, for example, inflation start to increase. You look at all the economic indicators, unemployment. You look at the Dow Jones. And so there's an argument, really, Zach, to say that the market could still go up another 300, 400, 500 points from where we are. Of course, there's uncertainty. You've got the political risk. You've got the Brexit situation. But at the moment, I think corporate earnings is kind of the number one thing that we're looking at. And the earnings don't lie.
Isn't that the thing that we've seen over like say the last 20, 25 years, that any time there's a shock in the market, it's a buying opportunity, a surprise is a buying opportunity. The ERM was, the dot-com bubble was, obviously the Lehman Brothers situation. It is, it's literally what I think Warren Buffett says about, the stock market's the only place where, when things are on sale, people don't want to buy.
Yes.
But normally in a shop, somebody says these shoes are half price or the suit's half price, they'll go for it.
2 for 1. Yeah, exactly. And we know that in the long run, the stock market always goes up. We know that, Same with the property market. I mean, I equate the property market and the stock market quite closely. I know they're not correlated necessarily, but if you look at, say, a 10-year, 15-year window, normally the stock market doubles, the property market also doubles. So, yeah, absolutely. And, of course, companies only get stronger. In the long run, good companies that pay dividends will only get better and bigger. So, and where else do you put your cash, Zach, right? You can't put it in the bank. Bonds are terrible at the moment. Interest rates are only going to go up from where we are. That's obviously going to push bond prices down. Yields will go up. So I think the stock market is benefiting not just because of corporate earnings and economic data, a global growth expansion, but also things like QE. A lot of people start talking about inflation. A lot of people should maybe start thinking about reflation. Where governments come in and start looking at monetary and fiscal policy to drive up and crank up earnings, profitability, and of course, our dear friend Mr. Trump on the other side of the pond, he's looking at what deregulation, BAT, the border adjustment tax, and of course slashing tax to 15% for companies. So all of these things would suggest, we might make a few more pennies yet.
Okay, well, I want to go back to what London Stone Securities does. Presumably, you have execution-only clients, you have advisory clients as well. 25 years ago, there was a lot more advisory than there is now. It seems to have become out of fashion. Obviously, the regulators are cracking down on everything else. From my memories as a broker, the beginners don't listen, and the people who are experienced, they also don't listen. because they think they know it all.
So, who's listening?
Exactly. So how do you do your job?
I think success and numbers talk a good game, and in my experience, most clients will listen to you once or twice at the beginning. They trust you, and then of course it's down to you or the broker or the trader that's managing the portfolio to prove success. I mean, people are intelligent, so in my experience, most people who don't take advice for a good reason, and that is because they've had bad advice. And the other reason people may not take advice is because the market's doing so well. But if you look at last year, for example, the stock market went up 20%. But if you look at most people's portfolios on execution-only basis, we do a lot of the stats, most portfolios went up by 10%. So where's the differentiation? And the difference is because the commodity sector was a sector that boomed, and most people missed it. So if you look at something like Anglo-American was up, 400% last year, Glencore, 300, 400% up last year. So I think it depends on the service that you provide. And of course, if you get it right, you make them money, you keep them happy, then of course they'll take more recommendations. So we're quite fortunate in that sense. And it's probably worth also mentioning that we also have a discretionary license as well. So execution only, advisory, and discretionary for those who want it.
Okay. The other point, I mean, it's an awful cliche, but the low-hanging fruit cliche. Let's say beginning of 2016, you had mining stocks, trading at discounts to I mean, literally, the gold mine was worth $1 or something like that. That was an obvious opportunity. Things that got ridiculous. But the problem now is with the FTSE 7500. There isn't any low-hanging fruit at all, is there really? How do you find value? How do you avoid being maybe caught high and dry on it's just a correction of 5-10% in the market?
Okay, good question. That's the number one question that people are asking right now. Okay, so for your viewers, I'm going to answer it as best I can. So the play at the moment is income. I think that's where the money is. If you start going for commodity stocks, you're going to struggle. I mean, Glencore was at 330 a couple of weeks ago. It's now, 270, 280. And the problem is with the mining stocks, as nice and as attractive as they might be for people looking for capital growth, I think people should do basically a risk-off trade. So basically take risk off the table and start getting income-paying shares for two reasons. Number one, if you end up holding the stock for a year and the share price goes down, you're still getting 5 or 6%, so you're not losing anything. And the second thing is, which is very important, and it's actually a strategy that I developed called the DIP, which is the Dividend Income Plus strategy, if anyone's interested, is a strategy that we use which basically measures the maximum price by which a share price might fall. And the way we do it is based on yields. So, for example, if you've got, let's say Centrica, for argument's sake. I know Centrica has got energy price caps and various things coming with Theresa May, possibly. But let's just use that for an example. If that's trading at, say, 230 or 235, it's offering a yield of, say 5%, just rough numbers. If it drops to £2, the yield will probably go up to, say, 6%. So with an income-paying stock, the share price can only fall by so much, beyond which the yield goes so high that it attracts investors from big pension funds. If you buy a company with no dividend yield, then you've got no floor. So my advice is really to go for value plays, like Warren Buffett says, look for income-paying stocks, dividend, play the long game. And of course, if you get caught out, the damage is limited.
And you don't think that, I think it was according to Mark Faber at the moment, everything is in a bubble at the moment. And so the value plays are too expensive and the growth plays are also, everything is just, gone through, it's done a sort of Amazon. Collective Amazon.
I'm not sure if I agree with that, no. So, and I'll tell you why. Because we still have, if you look at the numbers, we still are only back to 7,000 where we were in 2000. So we're only 400 or 500 points from where we were 17 years ago. And if you look at the European markets, you look at all of the uncertainty with perhaps the political tension, perhaps Macron, Le Pen. You had the Dutch elections. Now you've got the elections here next week. Then you've got the German elections. All of this uncertainty is still isn't creating an environment in which investors are scared. So I still think there's value to be had. And as I say, because no one can really predict the market, I can't predict the market any better than anyone else. What I can do, though, is make sure the assets are adequately placed to take advantage of the play.
So any shock with the election next week, 400 or 500 points, you would buy into that?
If the market fell 500 points, I'd put all my cash into markets and probably half of yours.
That's very kind of you. Ranjeet Singh, Director of London Stone Securities, thanks for coming in today.
Thanks, Seth.